The information expressed in this video is my opinion and my opinion only. This information is for entertainment purposes only. Please do your own research. Hey everybody, Dave here, Hidden Freedom Investing, and welcome back to another video. In this video, I want to go over Nationwide's Risk Managed Income ETF, NUSI. I've talked about this one in various videos over the last several months. It is a relatively large position in my portfolio, but I still think it's going to be a large portion of my portfolio, but it's also not going to be the largest position in my portfolio like I previously thought. So we'll look at my portfolio later on in this video, but I want to go over to NUSI because it is a really good income ETF if you're looking for income. It's got a different strategy than a lot of the other income ETFs out there. NUSI compared to say DIVO or JEPI, QYLD, XYLD, there's new Global X funds as well, which have a similar strategy as NUSI. I don't know, X collar, Q collar, or something like that. And there's some other ones, but I'll tell you why NUSI is different as well. Okay, risk-wide, so Nationwide Risk Managed Income ETF. This is a managed ETF. It's been out since December of 2019. It's got an expense ratio of 0.68. And I've had people comment over the last few weeks or so on the DIVO / JEPI video that this is a really high expense ratio. You know, I can invest in VU or I can invest in VTI and they have a way lower expense ratio. I'm like, it's not an apples to apples comparison. This is a managed ETF, okay, so you're going to get what you pay for. And those other ETFs are just passive ETFs that are really just following an index. Okay, there's nothing going on there. This is managed, and they're doing options, so that means that that requires them to get paid. Okay, now obviously you can't compare JEPI, you can't compare NUSI against SPY, or you can't compare it against VU or VTI or anything like that. Okay, those aren't income ETFs. And if you're thinking, well, the returns on those are way better, well, it's not the same thing. It's like driving around an electric car and driving around a gasoline car. They're not the same thing. They're both cars, okay, they're both ETFs here, but they're not the same thing. Okay, so you have to understand that NUSI and JEPI are not meant to outperform SPY. They're not meant to outperform the Qs. They're not meant to outperform VTI or VU. Okay, you get into these different income ETFs for different reasons. Okay, and today we're going over NUSI, which, if you're not familiar, it's a collar strategy. Okay, so let's just go through a little bit more details here. I just want to make you understand that information because I've had some comments, people thinking that these things are supposed to outperform the overall market, and they're not, okay? All right, total holdings there, 105 holdings, okay? So what NUSI does is they buy the QQQ stocks, okay? And then what they do is they run a collar strategy. So that's specific to NUSI, and it's a managed ETF, so they do move it around. They do say it's rules-based, but they also do move the spread around. So what they do is they sell a covered call against the SPX, and then what they also do is they buy a put on the SPX. So now they can take those off as well. They do them 1 month out. And, they can basically, the time that I've been following it, I've seen the spread change between the actual cover call and the actual put. It's not always the same. I've seen it down 5%. I've seen it down a little bit lower than that as well. And I think that's, just part of being a managed ETF. If they think the market's going to go down, then they might put it up higher. They might put it down lower. So they have a little bit of leeway there, even though they say it's rules-based. But they're not real specific on how they put those on or where they put those on. But I've just been tracking it for a few months, and I've noticed that they've kind of moved those numbers around. So, all right, distribution yield about 7.79%. Pretty good, okay? I mean, that's actually one of the best ones out there, especially for given what they're doing here. That is better than JEPI. That's better than DIVO. Obviously, it's not as good as QYLD. It's not as good as XYLD. Well, guess what? Those aren't the same strategy. All right, let's scroll down here, and this is what we see here. This is investment strategy overview. Step 1, purchase all the underlying QQQ stocks, deploy a rules-based option caller strategy, and then distributes monthly income from options, premium, and equity dividends. Additional premium may be used to reinvest in the underlying portfolio of 100 Nasdaq 100 stocks. So that's actually kind of cool. I like that step 4, because that might actually continue to keep it going up as well, even though, especially if they have a lot more income from options that particular month. So here are the top holdings right here. So the top holdings are Apple, Microsoft, Amazon, Facebook, Alphabet, Tesla, Nvidia, Alphabet again. And we got PayPal and Adobe. There's the top 10. Sector allocation, obviously we're heavy tech, so almost 49% there. Communication services, and then all the way down. And nothing in real estate materials, or they could just be too low to put in there. And here's the primary investing strategy. The fund is actively managed ETF that seeks to achieve its investment objective principally by investing in a portfolio of stocks included in the Nasdaq 100. And then run a caller strategy against that, which means they're selling covered calls, and they're also buying a protective put. Okay, the fund seeks to generate high income ETF. So the fund seeks to generate high current income on monthly basis from combination of dividends received from the fund's equity holdings and the premiums earned from the collared strategy. The options caller seeks to generate a net credit, meaning that the premium received from the sale of the call options will greater than the cost of buying a protected put options. Let's see here. The options caller is intended to reduce the fund's volatility and provide a measure of downside protection. Okay, and that's part of the reason why we get into NUSI. I don't think that NUSI should be your number one holding. Okay, because how often does the market go down? The market goes down, 30% of the time or something like that, or maybe less, I don't know. And then we're not even talking about a crash here, okay? We're talking about a slow bleed or something like that, or a long-term bear market. Those don't happen very often, okay? Neither do crashes. But NUSI really is only going to protect you against a crash, okay? It's not really going to protect you because they're doing month-out options calls and options on the put side. If they're doing a month out, well, guess what? If it's a slow bleed over that month, then the put side, which is technically just a hedge against the portfolio, which is what a lot of hedge funds do, which a lot of, large managed funds out there do these things all the time, okay? And you're thinking to yourself, Dave, I don't trust these options income ETFs. I don't understand what they're doing. I don't like what they're doing. And I just don't understand it, so I can't trust it. Well, guess what? Pretty much almost a lot of managed funds out there are doing some sort of hedge, and that's what they're doing. They're actually running a drag on the portfolio. Okay, that's how they protect their clients' money, just in case for those anomalies, right? This black swan events. And that's what NUSI's doing, is just doing it all the time. Okay, and luckily they can move the stuff around well. All right, so we kind of know what they're doing now. And obviously, so here's the call options, here's the put options here, kind of talking about what they're doing. Like I said, they're about a month out. And, depending on where the market's at, they might adjust those up or down and all that. So as we talked about in the last JEPI video, we know that there's a bunch of risks, obviously, as well. Here are all the risks right here. It's just with any income ETF or just any ETF in general. Now, there might be some more risks with an income ETF just because they're running a different strategy than what a VU or VTI is doing, which is just really an overall market. They're not running any calls or anything. So there's a little bit of added risk to it, right? Caller options strategy risk here. We got correlation risk. We have, currency exchange risk, depository. Let's see, derivatives risk, emerging markets risk, equity markets risk, ETF risk. So there's a lot of different risks underneath the ETF risk. Foreign investment risk, high portfolio turnover risk, industry exposure risk, limits operating history, and then market or management risk. Market capitalization risk, model and data risk, non-diversification risk, sector risk, tax risk, tracking stock risk. I mean, the list goes on, right? Now, every ETF in general is going to have a bunch of risks, right? And then you're just going to add a little bit more risk to this one because it's one sector, or excuse me, it's one, it's one index, right? It's the Qs, okay? Now there's different sectors in there, but, and then you got, the options on top of that, which add extra risk as well. So just don't get afraid of these risks, because if you look at any ETF prospects, their prospectus, they're going to have the risk as well. Okay, they're just going to have a little bit less risk because they don't need to put the options risk in there. And of course, everybody asks about tax information. So fund distributions are generally taxed as ordinary income, NII, so net investment income, qualified dividend income, or capital gains, or a combination. Unless your investment is an individual retirement account, IRA, other tax advantage account, such as a 401k, which you probably shouldn't have access to a 401k with these funds anyway, is my guess. Distributions on investments made through tax-deferred arrangements may be taxed later upon withdrawal. Of course. Okay, so what you don't get in this particular ETF is a return on capital like you do get on QYLD or XYLD, okay, or some of those other Global X income funds. So we're going to get ordinary income, which is from the options, and we're going to get qualified dividends just from the dividends in the actual equity holdings. And then we might get some capital gains as well, because they're selling the covered calls against the SPX, which is cash settled, by the way. So they might just distribute that out. It's all going to be most likely all short term. Qualified dividends is good. It means they're holding those funds for quite a while, or those equity positions for quite a while. So it is a little bit of mix there. It's not going to be all just ordinary income. So it is a bit of a mix, which is kind of good. Next year, when I go through the complete year or complete cycle, I will make a video on all the popular income ETFs that I have, because I have pretty much all of them, and talk about, how they affect tax-wise and whether I want to make any changes in 2022 going forward. So, and then kind of just breaking down the holdings here. So you can download the holdings if you just go to type in NUSI and you go to the nationwide website, and it has holdings right there. And the bad part about this right now is this is the 14th, which is the Thursday today, is they really only show the put side. They're not showing the call side, so they took the call side off. They capitalized all the premium on that, probably from the decline that we had recently, and then they just bought them all back and bought all those contracts back, and they left the put on. So the put is a 2021, looks like a, let's see here, October 15th, and it's a put at 14,725. So if we look here at, this is my Interactive Brokers account where I run options, just strictly options in this account. And if we look at the NDX right here, we can see that the NDX is 15,049. So obviously we're quite a ways away. Then I think this expired. Let's see here. We're going to click on that and look on the right-hand side over here. So here's October, let's see, October 14th is when I actually don't even going to show because they've already expired. So, which is sad because I was going to try to look at it. So I bet you tomorrow they're going to have probably new calls and new puts in there. So unfortunately, I really, they're probably going to go out a month. So they're going to go out to, November 15th, November 18th or something like that. And then they're going to put another put on and they're going to put another call on. But I wish I had time to make this video tomorrow on Friday, or over the weekend, but I have to release this on a Saturday, so we're not going to be able to look at that. So anyways, they do have a put here for October 15th, which is tomorrow, which is the one I probably just looked at. And that was 14,725. So it was a little ways down, right? And I don't know when they put that down, when they put that particular put on, okay? So they got 460 contracts there, which offsets the actual calls. Okay, so what they do is they sell calls, which normally brings in more income than what the puts cost. Okay, because they're buying these here. Okay, so whatever that cost is that cost them to buy it, well, they pay for that with the actual calls themselves, and then there should be some money left over. And guess what? That's what gets distributed to us. Okay. So obviously, the lower they go down in the put strike price, the less they're going to cost. But it's also doesn't protect you doesn't protect you as much because the delta is lower as well. Okay, so that's how they can kind of adjust it every single month, depending on what the market's going to do. They think the market's going to, go down a lot more than, I don't know. Just depends on what the market's doing, I guess. If you think the market's going to go down, and they can adjust that, okay? They can put the put down lower, they can put the put down a little higher. They can adjust the call side as well. So it's not completely fixed. So they can adjust that as well, especially depending on what the VIX is doing. All right, here is my Schwab account, and I'm just looking at the actual distributions here because the distributions have been pretty stable for the last, I'd say, a year or so. It's been about 17, 18 cents. So there is a bit of, speculation that if this thing crashes 30% or something like that because the overall market crashes, then maybe this will go down, and maybe it will, but it might not as well. It just depends whether or not. They're doing cash settle, so they don't really need to do, since they're selling against the NDX. I don't know if I said SPX earlier. I apologize if I said SPX earlier, but they're selling the covered calls against the NDX, so they're not technically selling it against their position, so it really doesn't matter. Nothing's getting it called away. It's all cash settled, so really, if the market goes down, and this goes down, 15, 20%, then I'm trying to think of why the income would go down. And this is kind of a question we're going to kind of, answer at the end of this video. But right now, the last several months, it's been stable, 18 cents, 17 cents. And a lot of just depends on what day, because I think they pretty much do it the same cycle every time, 1 month out. And whether the market's down that day or the market's up that day. So that kind of depends on how much income they're going to have for that next month going forward, right? Okay, we're looking at FinViz. I got NUSI pulled up here, and NUSI's been following with this up channel here. So it's been pretty much on a decline for about a month and a half since September down to the middle of October here. And then today we had a pretty big update. Of course, the overall market had a update today as well. So 7.6% is what they're showing in the distribution yield. And right now, year to date, we're down 1%. You're thinking, oh, Dave, this thing doesn't perform very well. Well, you're not really getting into this, particular income ETF to outpace the market. Okay, this has a drag on the portfolio. It's not going to perform like a JEPI. It's not going to perform like a DIVO. It's not going to perform like a SPY. It's not going to perform like a QQQ. It's not going to perform like a QYLD or an XYLD. It's not the same thing, okay? All right, so they got a drag on the portfolio, which means you're going to protect you on the downside in a crash scenario, okay? All right, so this drop right here is not protected because it's kind of a slow bleed, okay? Now you say this dropped in 1 month, but if you calculate that out right there, it wasn't that big of a decline, okay? In order for those puts to really start printing, they have to be, 5, 10%, I'd say 10% beyond, okay? Yeah, it's going to start printing as soon as the market goes down, depending on when they put them on, if it didn't go up right away. So if they just say put the puts on and it went down the next day 5%, then yes, those puts will print. But the more it goes down and the faster it goes down, the more they're going to print because the delta will increase, and along with the IAV and all that. And then they can sell them, and which they'll probably likely do. If this market crashed, 20% or something like that in a month, what it would do is those puts would start printing and then just end up selling them is what they would end up doing, and then they just turn around and start the whole process over again. And guess what? Those covered calls on the other end are actually going down in value, which is good because they sold them, right? And then what they do is they can buy those back cheaper, okay? So actually going down is actually not a bad thing, especially in a crash type of scenario. So now that we've talked about some of the interesting things about NUSI, we can tell that, this is just not an apples-to-apples comparison pretty much against any other ETF out there. and you have to understand what you're getting into, why you would get into NUSI, and you have to be okay with the 7.6% distribution, okay? And yes, you can make some money on the capital appreciation side, but it is a hedge. It's not going to be as good as a lot of the other income ETFs out there because you have a drag, okay? All right, so I think this is a good price right where it is right now. As a matter of fact, I believe it's barely selling at a premium above net asset value at this point. I think if we go back here to Schwab and we go to summary, we can look at the net asset value. So let's see here, net asset value, premium discount. So it is a slight premium right now. Closing net asset value, 27.12. And so let's see, previous close, today's open. What was today's close? I don't see today's close, but so we're selling at a slight premium, but I still think it's a great price to get in to NUSI because look at it, we're down here at this lower the channel line. So I think this is a great price for NUSI at this point. And so if you're looking to get into NUSI, I don't think this is a bad price to get into it. Okay, and I told you that I would show you my portfolio. So right now, I mean, we had look at this, up $10,000 today. That was a major update today. And look at this down here. This is what's even more interesting. Look at this. The VIX went down 25, almost 26% today. So that is bringing the premiums down, unfortunately, which is not good for NUSI or any pretty much income ETF out there because the premium is going to go down in value. So what they're going to do is probably, I would say that maybe the distributions on all these income ETFs may slightly go down in October, November timeframe, especially if the VIX continues to drop. Okay, current portfolio. I kind of told you I look at my portfolio because I'm sure everybody wants to know. So let's just scroll down right here and scroll back up. Okay, so here's my portfolio right now. And here's DIVO right here, 145,000. JEPI, which is the next biggest position there, 145,000. Oh, actually, I need to readjust those. So let's just do this. So the biggest portfolio position right now is JEPI, 145,000. We got DIVO there, 145,000. Then we have NUSI there, 143, almost $144,000. So I'm trying right now. Those are pretty much all equal, and I do have plans to build out JEPI to 200,000 and DIVO to about 160, 170,000, and NUSI about 200. But honestly, after doing a lot of research, I might actually dump some of the NUSI into JEPI and some of the NUSI into DIVO and maybe lower the allocation of NUSI just a little bit. So obviously, I think that those top three holdings right there are core positions for me. And obviously you can tell I have XYLD and QYLD there as well. And those are just strictly for income. I don't really care, but those are strictly only for income. So these three here are my main ETFs, and obviously QQQ and SPY will be as well down the road in the retirement account. While right now these are only held in the taxable account. So I kind of like the way that these three work together. Okay, NUSI kind of protects you on the downside a little bit. It's against the NDX, so the QQQ stocks. DIVO is just a covered call, a dividend portfolio. So it's pretty much close to a traditional dividend portfolio that you're running covered calls against yourself, which I was doing for quite a while. And then you have JEPI here, which is S&P 500 type stocks that has only about 20% of ELNs, which are similar to covered calls in a way. It's a structured product, so it's a different index than what NUSI is, and it's a different strategy. So what I can think here is the market goes down. Well, guess what? One of these is not going to perform as bad as the other, okay? I would say that JEPI might perform worse than, let's say, NUSI if we have a 30% decline. And guess what? Then I can kind of move some capital out of NUSI into JEPI or something like that, or vice versa. So this kind of gives me an opportunity here to move funds around should one do better than the other on a market decline, or I can even, kind of sell off if the market's been going up 30 or 20 or 30% in a year, which doesn't happen very often. But if it does, I can trim something out and move something over here into a different fund, right? Anyways, I hope everybody had a great week. We had a monsters update today, and if you have any questions, comments, sure leave a comment down below. Anyways, until next time, please go and like and subscribe. We'll see you next video. Thanks for watching.